What if the biggest change in the gold and silver market last week was not a chart pattern, not bullish sentiment, and not another prediction from Wall Street? What if it was a policy decision that changed the way investors are looking at the bond market? Welcome to Macro Bullion. I'm Alex James, an independent economic analyst, and today we're going beyond the headlines to examine what actually changed in gold and silver and why the next move could depend on something much bigger than sentiment. Before we go any further, I want to make one thing clear. On this channel, we separate verified facts from analysis and prediction. The market can move in ways that make a forecast look brilliant one week and completely wrong the next. So the goal here is not to claim certainty. The goal is to understand the evidence and follow the data. And the evidence from last week was significant. Gold moved through the $4,500 area after the U.S. Treasury announced that it would at least double the size of certain liquidity support buyback operations for longer-dated Treasury securities, taking the size from $2 billion to at least $4 billion per operation. Reuters reported that the announcement was followed by a sharp decline in longer-term Treasury yields and a major move higher in gold. That matters because the bond market sits at the center of this entire story. For months, investors have been watching long-term Treasury yields closely as concerns over inflation, government borrowing, and the size of U.S. debt have intensified. When long-term yields rise sharply, financial conditions can tighten, borrowing costs can increase, and the attractiveness of non-yielding assets such as gold can change. Then Treasury stepped in with a larger buyback program. Now, I want to be precise here. This does not automatically mean the United States has started quantitative easing, and it does not prove that the government is deliberately trying to push gold higher. Treasury describes these operations as liquidity support for longer-dated securities. The market reaction, however, was unmistakable. Yields fell, the dollar weakened, and precious metals surged. That distinction is extremely important because there are two separate questions. The first is what Treasury actually announced. The second is what investors believe that announcement tells them about the financial system. And those are not necessarily the same thing. Gold does not need a government official to say buy gold for the market to react positively. If investors see rising fiscal pressure, changing Treasury issuance patterns, falling long-term yields, and uncertainty around the dollar, they may increase demand for an asset that is viewed as a hedge against monetary and fiscal risk. That is why the move above $4,500 deserves attention. But it does not mean gold can only go higher from here. That would be an irresponsible conclusion. Markets can correct, momentum can reverse, inflation can surprise higher, Treasury yields can rise again. And if the underlying macro conditions change, gold and silver can respond very quickly. So the real question is not simply, is gold bullish? The better question is this: what has changed in the financial system that could keep investors interested in precious metals even after the initial excitement fades? That is where this story gets much more interesting. We're going to examine the bond market, the Treasury buybacks, the dollar, and the debt problem, while separating what we know from what we are only inferring. The important thing to understand is that a Treasury buyback is not the same thing as the Federal Reserve simply creating money and buying bonds. That distinction matters because it changes how we should interpret what happened last week. The U.S. Treasury already had a buyback program designed to improve liquidity in parts of the Treasury market. In its August 5th refunding statement, Treasury said it expected to purchase up to $38 billion of off-the-run securities during the quarter for liquidity support, alongside separate cash management buybacks. Then, on August 19th, Treasury announced that the size of certain longer-dated buyback operations would increase from a $2 billion maximum to at least $4 billion per operation. So the first fact is straightforward: the program became larger. The second question is why. And this is where the bond market becomes important. When investors sell Treasury bonds, their prices fall and their yields rise. When demand for those bonds increases, prices can rise and yields can fall. Longer-dated bonds are particularly sensitive to expectations about inflation, government borrowing, economic growth, and future interest rates. That is why the rise in long-term yields had become such an important market story. Reuters reported that the 30-year Treasury yield had reached its highest level since 2007, before the Treasury announced the larger buybacks. The announcement initially brought relief to the bond market, with long-term yields falling sharply and the dollar weakening. But here is the part we need to be careful with. A buyback can improve liquidity and support demand for particular securities, but it does not automatically solve the underlying fiscal problem. The U.S. government still has enormous financing requirements. Treasury continues to issue debt, and investors still have to decide what yield they require to hold that debt. If concerns about inflation, deficits, monetary policy, or the supply of government bonds remain, a temporary improvement in liquidity does not necessarily remove those pressures. In fact, Reuters reported the following day that much of the initial decline in yields had reversed. The 10-year yield moved back toward 4.70%, while the 30-year yield rose toward 5.25%. Analysts described the buyback as potentially providing short-term relief, while the deeper drivers of long-term yields remained. That is a crucial distinction for gold investors. We should not say, Treasury bought bonds, therefore gold must go higher. That is too simplistic. The more defensible argument is that the Treasury intervention highlights how sensitive policymakers and markets have become to conditions at the long end of the bond curve. And that matters because long-term borrowing costs affect much more than government bonds. They influence mortgages, corporate financing, investment decisions, and the broader cost of capital. If long-term yields remain elevated, financial conditions can tighten even if the Federal Reserve is not changing its policy rate. This creates a complicated situation. The Fed controls short-term monetary policy, Treasury manages the government's financing operations, and investors ultimately determine the prices and yields of Treasury securities through the market. When those three forces move in different directions, volatility can increase. Reuters also reported that the larger Treasury buybacks could complicate the Federal Reserve's monetary policy strategy, particularly because a decline in long-term yields can resemble a form of financial easing even when the Fed itself has not changed its policy rate. Now bring gold back into the picture. Gold does not pay interest. So when real yields rise significantly, gold can face pressure because investors have a stronger incentive to hold interest-bearing assets. But when investors become concerned about inflation, fiscal sustainability, currency risk, or financial system uncertainty, gold can attract demand for a completely different reason. That is why the bond market matters so much. The question is not whether one Treasury announcement guarantees a gold rally. It doesn't. The question is whether the forces behind the bond market stress are temporary or structural. If the pressure is temporary, gold could consolidate after its sharp move. If those pressures persist, however, the macro backdrop becomes much more interesting for precious metals. And this is where silver becomes even more complicated. Silver is not simply a monetary metal, it also has major industrial demand. That means silver can benefit from monetary uncertainty, but it can also be hurt if rising yields and tighter financial conditions begin to weaken economic activities. So as we move forward, I want you to watch three things together: long-term Treasury yields, the US dollar, and precious metal positioning. Don't look at any one chart in isolation, because the real story is not simply that gold broke through a resistance level. The real story is that the bond market is becoming increasingly important to the entire macroeconomic narrative. We're going to look at the biggest question of all, whether this precious metals rally is attracting genuine new participation or whether investors are simply chasing a move that has already happened. Now we get to the part of this rally that could determine whether the move continues or eventually runs out of momentum: participation. Price tells us what happened. Positioning can help us understand who is behind the move. For much of this precious metals rally, one of the interesting features was that the price was moving higher without what looked like an overwhelming speculative crowd. That created an unusual setup. Gold and silver could rise, while a large portion of investors were still standing on the sidelines. That matters because a market can continue moving higher when new buyers are still available. And there are signs that this is beginning to change. The important distinction is that increasing participation is not automatically bearish. In fact, when price rises and new positions enter at the same time, that can provide confirmation that the trend is attracting fresh capital rather than simply moving because existing holders refuse to sell. That is one reason the recent move in gold deserves attention. Gold broke above $4,500 and then pushed beyond $4,600. Market reporting from the week showed the metal gaining sharply as the dollar weakened, and investors responded to concerns around U.S. fiscal conditions and the Treasury's expanded buyback operations. Silver has also been participating. The metal moved back toward the upper 60s after the Treasury announcement, with Reuters reporting silver around $68.16 on August 20th after a 1.9% gain that day. But here is where I want to slow the story down. A rising market with increasing participation can be bullish. A rising market with rapidly increasing participation and extreme leverage can eventually become fragile. Those are two completely different situations. If new investors are gradually entering because the macroeconomic case has changed, that can support a sustainable trend. If investors are entering simply because they see gold and silver rising and believe the next move is guaranteed, the market becomes more vulnerable to a sharp correction. That is why I would not use sentiment as a timing tool by itself. Sentiment is useful as context. Price, positioning, yields, the dollar, and policy developments have to be considered together. And this is particularly important right now because the Treasury announcement has changed the conversation. The World Gold Council noted that gold rallied around 3% following the August 19th buyback announcement as Treasury yields and the dollar fell, but it also emphasized that the action should not simply be interpreted as formal yield curve control. That is an important warning against exaggeration. We can say the announcement mattered. We can say the market reacted strongly. We can say lower yields and a weaker dollar created a supportive environment for gold. But we should not jump from those facts to the claim that the government has guaranteed a permanent gold rally. It hasn't. And silver has another layer of risk. Unlike gold, silver has substantial industrial exposure. If global growth remains strong, that industrial component can support demand. But if financial conditions tighten sharply and economic activity weakens, silver can experience more volatility than gold. That means silver's next move could be more explosive in either direction. Now look at the technical picture. Gold has moved through a major psychological area around $4,500 and above $4,600. That is a genuine improvement in market structure, but every breakout eventually has to prove itself. A level becoming resistance after a breakout is normal. So if gold pulls back toward $4,500, that does not automatically mean the bullish thesis has failed. What matters is what happens there. Does buyers step back in? Does the dollar strengthen? Do Treasury yields rise again? Does open interest continue increasing? And does the metal hold above the breakout zone? Those questions are more useful than simply asking whether someone is bullish or bearish. The same principle applies to silver. Silver has now tested the $70 area, which makes $70 psychologically important. But a test is not the same thing as a confirmed breakout. If silver can establish itself above that zone with strong participation, the market could attract even more attention. If it repeatedly fails and momentum fades, consolidation becomes much more likely. And that brings us to the most important warning in this entire section. The crowd arriving can be both confirmation and risk. Confirmation because new participation can strengthen a trend. Risk because the more crowded the trade becomes, the less asymmetric the setup can become. So I am watching one thing very closely from here, whether participation continues to expand gradually alongside price, or whether speculation suddenly accelerates while the underlying market stops making progress. That difference could tell us whether this is the beginning of a broader precious metals trend or simply another powerful leg inside a much larger and more volatile cycle. And now we have to confront the biggest test ahead: inflation, the Federal Reserve, long-term yields, and the possibility that a single economic report could challenge everything the market currently believes. Now we reach the part of the story where the bullish case has to face its biggest test. Because Treasury buybacks can influence liquidity, bond yields, and the dollar, but they do not control every variable that determines the price of gold and silver. The Federal Reserve still matters, inflation still matters, economic growth still matters. And perhaps most importantly, the bond market still matters. That is why the next few trading sessions could be extremely important. Markets are looking ahead to the latest inflation data and to Federal Reserve Chair Kevin Warsh's appearance at Jackson Hole. Recent reporting shows that investors are watching these events for clues about the direction of monetary policy and the outlook for interest rates. Here is the basic mechanism. If inflation comes in softer than expected and investors become more confident that monetary policy can eventually become less restrictive, Treasury yields could come under pressure. A weaker dollar and lower real yields would generally create a more supportive environment for gold. But if inflation surprises higher, the equation changes. Higher inflation could force markets to price a more cautious Federal Reserve. Treasury yields could rise again and the dollar could strengthen. That would create a headwind for gold and silver. This is why I don't want to tell you that the Treasury announcement has created a guaranteed one-way market. It hasn't. It has changed the information investors are working with. And that distinction is everything. Gold has already demonstrated that it can move aggressively when the dollar and long-term yields move in its favor. After the Treasury announcement, gold broke through $4,500 and later traded above $4,600. Silver also pushed toward the $70 level. But after a move this powerful, the market has to prove that the breakout can hold. For gold, the first number I would continue watching is $4,500. Why? Because once a market breaks through an important resistance zone, traders naturally watch to see whether that former resistance becomes support. A pullback toward $4,500 would therefore not automatically invalidate the bullish structure. The reaction at that level would tell us much more. If buyers defend it and the dollar remains weak, the market could attempt another move higher. If gold falls through it decisively and long-term yields start rising again, the breakout becomes much less convincing. Above the market, $4,600 has now become another psychological reference point, while $4,700 becomes an obvious area investors will watch if momentum continues. But again, these are levels to monitor, not promises. Silver presents an even more interesting setup. The market has already tested $70. That means the psychological barrier is no longer theoretical. It has been reached. If silver can establish a sustained move above $70 with continued participation, momentum traders could become more interested. But if silver repeatedly fails around that level, a period of consolidation would be completely normal, and silver can move much more violently than gold in both directions. That is why I would rather watch confirmation than chase a number. Now let's bring the macro picture back into focus. There is a genuine contradiction developing. On one side, policymakers and markets want long-term borrowing conditions to remain manageable. On the other side, persistent inflation and enormous government financing needs can keep pressure on long-term yields. Treasury buybacks may improve liquidity in selected parts of the market, but they do not eliminate the broader questions surrounding fiscal sustainability. That is precisely why the bond market is becoming such an important signal for precious metals investors. If long-term yields remain elevated while gold continues rising, that tells us something very different from a normal rate-driven gold rally. It would suggest that investors are increasingly looking beyond the traditional relationship between yields and gold and paying more attention to fiscal and currency risk. That does not mean gold becomes immune to interest rates. It means the market may be assigning greater weight to other risks. And that is the central question I will be watching. Does the dollar continue weakening? Do real yields continue falling? Does investor participation continue increasing? Does gold hold above the breakout zone? And can silver finally establish itself above $70? If the answer to several of those questions is yes, the bullish structure becomes stronger. If the dollar rebounds, yields rise sharply, inflation surprises higher, and gold loses $4,500, then the situation changes very quickly. There is another important point here. A correction would not necessarily destroy the longer-term thesis. Markets do not move in straight lines. Gold can pull back after a 4% or 5% weekly move. Silver can consolidate after testing a major psychological level. Momentum can cool without the underlying macro story disappearing. That is why I don't want to confuse volatility with failure. The real failure would be a breakdown in the underlying evidence. If Treasury support is reduced, if long-term yields surge, if the dollar strengthens materially, and if precious metals lose their breakout levels, then the bullish argument needs to be reassessed. And I will say that openly if it happens. Because credibility is not about being bullish every week. Credibility is about having a framework that survives both the bullish and bearish outcomes. Right now, the evidence says the precious metals market has momentum, the dollar has weakened, Treasury policy has become an important market driver, and investors are waiting for fresh inflation and Federal Reserve signals. That creates opportunity, but it also creates risk. And the next part is where I want to put everything together. What actually changed, what could invalidate this thesis, and what I believe investors should be watching from here. So let's bring the entire argument together, because this is where I think the distinction between a good market story and a reliable market framework really matters. The bullish case for gold and silver has become stronger, but that does not mean the market has become risk-free. What actually changed last week was not simply that gold crossed another technical level. Treasury announced larger liquidity support buybacks for longer-dated Treasury securities. The market reacted with lower long-term yields, a weaker dollar, and a sharp move higher in gold. Reuters reported that gold jumped more than 4% on the announcement day, while the dollar weakened significantly. That is a fact. What comes next is analysis. My interpretation is that the announcement reminded investors how sensitive policymakers and markets have become to long-term borrowing conditions. But we should not turn that interpretation into a claim that Treasury has guaranteed higher gold prices. It hasn't. The buyback program is relatively small compared with the overall Treasury market, and subsequent trading showed that long-term yields could rise again even after the initial announcement. That means the underlying bond market problem has not disappeared. And this is exactly why I want to keep three scenarios in mind. Scenario number one is the bullish continuation. If inflation data comes in reasonably soft, the dollar remains under pressure, long-term yields stay contained, and gold continues holding above the $4,500 area, the breakout could develop further. Gold has already traded above $4,600, while silver has approached the $70 area. Current market coverage identifies inflation data, and Federal Reserve Chair Kevin Warsh's Jackson Hole speech as the major catalysts for the coming week. Scenario number two is consolidation, and honestly, this would not surprise me at all. Gold has just experienced a very powerful move. Silver has also advanced sharply. After a move like that, investors can take profits, momentum can cool, and prices can move sideways without destroying the larger trend. A market does not have to rise every day to remain bullish. Sometimes the healthiest development is simply that price stops falling when sellers expect it to. Scenario number 3 is the failed breakout scenario. This is the one I would take seriously. If gold loses $4,500 and then breaks materially below the next important support area, while Treasury yields and the dollar strengthen at the same time, the recent breakout would become much less convincing. And if participation rises aggressively while price stops advancing, that would also be a warning that speculative fuel is being consumed too quickly. That is why I don't want you to focus only on the headline number. Watch the relationships. Gold versus the dollar, gold versus real yields. Silver versus gold, Treasury yields versus Treasury policy, and price versus positioning. Those relationships can tell us much more than a single bullish headline. There is also a lesson here about sentiment. Earlier, extreme bullish sentiment looked like a reason to be cautious, but sentiment did not stop the market from moving higher once the macro backdrop changed. That does not mean sentiment is useless. It means sentiment is a secondary signal. When something structural changes, yesterday's positioning can become outdated very quickly. And that brings me to the 3 levels we have been watching. Silver around $55 was an important historical reference in the original framework. Silver around $70 is now a major psychological test. And gold around $4,600 has become an important confirmation zone after the recent breakout. But I want to be very clear. Reaching a level does not prove that the next target is guaranteed. Markets do not owe us the next move. They only give us evidence. So what would make me change my view? A sustained move back below the breakout area, a renewed surge in long-term Treasury yields, a meaningful strengthening of the dollar, inflation data that forces markets to price a more restrictive Federal Reserve, or evidence that speculative participation has become excessive while price momentum is weakening. Those are the things that could invalidate the bullish argument. And what would strengthen it? Persistent weakness in the dollar, contained long-term yields, continued institutional demand for gold, healthy participation rather than extreme leverage, and most importantly, gold and silver holding their breakout zones when tested. That is the framework I will be watching, not predictions for the sake of predictions, not sensational targets, evidence. Because if this market continues higher, I want to understand why. And if it reverses, I want to understand why that happened too. That is what independent analysis should be. So the conclusion is simple. The precious metals market has entered a more important phase. Gold has broken above $4,600. Silver has approached $70. Treasury policy has become a major market catalyst, and investors are now waiting for fresh inflation data and the Federal Reserve's Jackson Hole message. The bullish case is real. The risks are real too. And the next move will depend on which side of that equation the data confirms. If you found this analysis useful, subscribe to Macro Bullion and tell me in the comments. Do you think the next major signal will come from inflation, the Federal Reserve, or the Treasury market? And one final point. This content is for informational and educational purposes only. I am not a financial advisor, and nothing in this video should be considered financial advice. Always do your own research, verify the underlying data, understand the risks, and make decisions based on your own circumstances. The market will decide what happens next. We will follow the evidence. See you in the next analysis.